Good morning, everyone. I'm Mark Phillips here with Harvested Financial, and we are going to talk about the markets and talk about how to use options to take advantage of the opportunities to manage your portfolios. So, today is Thursday, February 25th, and we have a lot going on in the markets right now. Of course, GameStop is back up there. Everyone's talking about it, and I want to give a quick teaser for our show later this morning that I'm going to be doing with Lex over at Tradier. Our midday market shot. It's going to be at 11 a.m. Central. We're going to be talking all about GameStop and what's going on there with the Gamma Squeeze. It's back. GME does not stand for Gamma Squeeze as much as one might think, but we're going to be talking about that in a little bit later. So now we've got today's markets, and we're looking at SPY pretty flat right now, down 41 cents. When we printed this, it actually just ticked green, so trading around 391.76. We had a big run up yesterday afternoon. IWM a little in the green at 226.80. The Qs are off a little bit. That tech selling seems to continue. I'm not sure if it's quite a value rotation, but the Qs have been off more than anything recently. VIX up a little bit, trading $22.86. And Bitcoin coming back up, a little 3% rally overnight, and we're trading around 51,193. That's up $1,600. So continues to be a lot of pressure and support there on the buy side. Saylor came out and is buying more. We've got Square buying more. So that's another asset that continues to see a lot of support. So what do I want to talk about today? What do I want to look at? Well, it is Thursday, and so we are going to be looking at vertical strategies. And I want to pull up NKLA because NKLA, the electric vehicle maker, they've got earnings this afternoon, and we are going to talk about how to use credit put spreads to express a bull thesis and capture some premium in a high vol name. So NKLA is, like I said, they've got earnings after the close. Some interesting things going on here. As much as this has been moving around so much, and we'll see in just a minute with some of these high implied volatility numbers, it's been relatively stable recently. The historical vol is actually maintaining a relatively stable price below where the implied volatility is trading, because there just hasn't been a lot of that turbulent movement and news cycle coming out here. All of that said, there still remain a lot of questions. While this has been hyped, while there has been a lot of questions about their delivery and how many vehicles they can produce, it's got a lot of fervor around it, but it's certainly not a leader in this industry. When we want to talk about the electric vehicle industry, it's obviously names like Tesla that are really leading the field here. So certainly some concerns out there too, but that's why we like to use defined risk spreads to execute the trades, and we'll get into that in just a sec to look at how to manage the risk, because of course if this was a pure play or a certain play, then there wouldn't be any risk, and that's not trading, is it? And the last point I have here actually is that there's relatively low coverage by institutions. So there's actually only one major institutional fund that is an owner here, mutual fund, I mean. And so the fact that there isn't necessarily institutional support behind this, makes it potentially fall into that whole meme stock range. So I'm going to pull up my screen share very quickly, and let's talk about sort of what we can do here with some of these credit spreads. I'll pull myself down just a little bit. I'm looking at NKLA here, and the March 19th options. I'm going to go out about 21 days, about 3 weeks. As we often talk about here, the liquidity in these serial months tends to be pretty good. So certainly something we want to think about. It's not trading around $21 right now. I'm thinking about a credit put spread because I'm thinking about a put spread and a credit because I want to capture that implied volatility, that really high implied volatility. We're trading around 126 right now. So to give a sort of brief idea of what 126 vol means, well, I got some calculations for y'all here. The implied daily move on 126% implied volatility is going to move around 7.8% a day. That's $1.63. We're off 21 cents today. This name has certainly had moves, but as you'll see here, the average daily move is less than 7% a day, 66% of the time. So I went back, I looked at the last 6 months of data and said, how many times does this move actually more than that 7% a day? And it's not that much. It moves less than that 66% of the time. So that's a good reason that we might think about entering a credit spread. Another reason why we might think about entering a credit spread is some of this historical volatility that I've been talking about. So the yellow line is the price chart, and you can see the huge spike in May of last year, traded all the way up to 80 bucks, chopped around quite a bit, crashed all the way back down. We've seen some volatile action here, and so it's no surprise that it's the implied volatility is trading at that 126% level. But if I want to zoom in over the last little bit here, this red line is my historical vol. And that's going to be a close-to-close number. It's only 43. It's only 43%. And that's compared to an implied volatility of 30-day implied volatility here is reading 121. I think we saw 126 in the markets a little bit before. So trading at a significant clip above that. We certainly have earnings. Earnings are a risk. Going into an earnings event, you always want to manage your downside. So that's why I like doing a spread. We're not just going to sell volatility because we think it's expensive here. We're going to sell it because we think it's relative to historical in a defined risk manner. So this really flatlined historical volatility, as shown by the relatively, it's a little bit of a drift down, but certainly not the super choppy price action that we're talking about. I'm going to pick the 20 put spread as my initial anchor. So it's about 70 cents away from at the money, and the at the money options are always going to have the most vega volatility. So if you want to sell vol, you want to sell the at the money option because that's going to have the highest, volatility, extrinsic value in it. So selling 20, it's a nice psychological floor too. That's another kind of factor that goes into the decision here of what, we're picking our strikes. So really tight spread here that we're going to go for. I'm going to go for the 2019. And right now, the midpoint here is around 47 cents. The markets are a little bit wide, so I'll definitely note that. We have 11 cents wide in this 19 market, and we have 10 cents wide in that 20 market. So it's 20-cent wide market overall that you're going to have to get into. If you want to smack the bid right here, you're going to only collect 37 cents. So important that you manage execution quality here. I think given where we're seeing execution quality pricing in the markets right now, with a midpoint of 46 cents, 13 cents to the bid. If you can get half of that, if you can get executed around 41, 42 cents, you should feel pretty good. There's decent volume in here, so market makers are likely to provide good liquidity, especially on a defined risk spread. So that means they can lay off part of their risk also. So, spreads have a lot of advantages, and you definitely want to think about executing these as a package and not necessarily trying to leg into that. Leg execution risk is always something that can get you. So spreads trading around 48 cents right now. What this means is I have a $1 put spread, 2019. The max loss on this, super important to think about your max losses and risk management here. Your max loss is going to be, I shouldn't say loss, the max value of this spread that you're short is going to be $1. So if you collect 45 cents, let's say you get a great fill, collect 45 cents on this, your max risk is going to be $55. You could lose $55 on this position for every contract that you execute. So it's not quite a 1-to-1 odds, but it's relatively close. So, of course, this is trading a little bit out of the money, and that's why, it's not exactly going to be that 50% odds. But this is a great way to make a close to even money proposition that Nikola will trade above $20 in the next 3 weeks. I should say close above $20 at the end of 3 weeks, because that's when these options expire. But collect 45 cents on this trade, max risk of $55 if Nikola trades above $20. Nice defined risk, odds-on way to manage your positioning here. This is a great opportunity capture given the high elevated implied volatility levels, and it makes for a great way to roll into that. So at Harvested Financial, we're thinking about these kinds of strategies all the time, whether it's in advance of earnings, whether it's in advance of other events, or just systematically staying exposed to a thesis here. This is a bullish thesis that you'll have on Nikola, but you're collecting the premium. So it's a nice way to have a credit strategy, capture volatility premium while leaning bullish on the stock. So check us out every day here. Mash the subscribe button. Make sure to tune into the Daily Bread every day at 8:35, 9:35 Eastern. And we'll be talking about option strategies because that's what Harvested Financial does. We execute systematic derivative strategies for everyone. Like I teased at the beginning, make sure to tune in also to our midday market shot at 11 a.m. Central Time, 12 o'clock Eastern, where we were going to dig into GameStop and what is going on there. We are seeing another gamma squeeze. It's unbelievable. A lot to talk about. Make sure you tune in for that one also. And thanks